Hello and welcome to our presentation of Christmas results. My name's Nick Gladding. It's been a fascinating reporting season, the one time of year when we get to read a trading performance right across the grocery sector and find out how successful retail has been at securing sales at the most important time of year. Over the next 20 minutes, I'll talk through how Christmas played out for the sector and go on to look at some of the challenges facing our industry in the year ahead. I'll also highlight some of the events we've got coming up to help you trade more successfully in 2019. So this is the ground we'll cover. We'll start by dipping into our Shopper Vista research. What did shoppers tell us about their priorities in the run-up to Christmas? I'll then run through the retailers that have released results, looking at what drove their performance, and also look separately at the trends impacting online. I'll then bring together the key themes and finish up by highlighting other ways in which IGD can support your business. So to get us started, some insight from our Shopper Vista research, carried out in November, giving us a window into the mindset of shoppers in the run-up to Christmas. You can see from the left-hand chart that despite the uncertain economic backdrop, there's been an increase in the proportion of shoppers who believe Christmas is a time to splash out on food and groceries, from roughly half to 70% of shoppers over the last 2 years. At the same time, only 1 in 3 claim to have a set budget for Christmas groceries this year. This suggests that the majority of shoppers saw Christmas as an opportunity to treat themselves and their families, having been cautious throughout the year. We also found that over half of shoppers aspired to start shopping for food and groceries early in order to spread the cost. This was up from only a third of shoppers 2 years ago, with shoppers keen to take advantage of promotions by buying ambient and non-food products early. We also asked shoppers how willing they were to spend a bit extra to buy better quality products, and you can see the response varies hugely by category. Overall, only 11% of shoppers said they weren't willing to spend more at Christmas to get higher quality, but there was a real appetite to spend more on better quality products in categories such as meat, cheese, desserts and wine, the staples of the Christmas meal. So back to Christmas trading, and the chart shows like-for-like and total sales for the retailers that have reported. You can see some big variations between retailers, so over the next few slides, we'll have a look at the numbers in some more depth. Let's start off with the discounters, which as a group were the obvious winners this Christmas. Shopper enthusiasm for discounters came out strongly in our Shopper Vista research that we ran just before Christmas, when 1 in 5 shoppers we interviewed said they planned to buy more from food discounters this year. However, sales growth turned out to be not as strong as last year. At Aldi, UK growth slowed to 10%. Data was only given for Aldi's busiest ever week, the week running into Christmas Eve, but this was much slower than the 15% achieved in both 2017 and 2016. Much of this growth was driven by new stores. We know that Aldi finished the year with 8.5% more stores than it started with, so like-for-like growth will have been marginal at best. Lidl reported 8% growth for the whole of December. Again, well down on 2016, but still very rapid growth. In the variety discount sector, we don't have as much data as in previous years, but we do have numbers for B&M. Its UK like-for-likes declined by 1.6% against a tough 3.9% comparative. Total sales were up by 4.5%, with strong trading in December helping to make up for a disappointing November. B&M finished the year with 42 more stores than it started with, and 20 of these opened in the final quarter. Revenues at Heron Foods, the frozen food retailer that B&M acquired in summer 2017, rose 12.6%, a good performance given that the business was annualizing against range extensions made post-acquisition. Turning back to Aldi, what were the factors that drove performance? Certainly, premium ranges were important. Aldi said its specially selected and exquisite ranges were its largest and most ambitious yet. Highlights included 3 little pigs in blankets, a tear and share bread wreath, and a chocolate carousel. Aldi sold 17 million bottles of wine, champagne and Prosecco during December, with its rapidly growing online business supplementing store sales. Its advent calendar range included a wine version priced at almost £50. The popular Kevin the Carrot character had a starring role in Aldi's TV campaign at Christmas for the 2nd year running, ensuring a high profile for the campaign and a sellout of soft toys. Though its sales growth was half the 16% reported for December 2017, Lidl was once again one of the strongest performers at Christmas, helped by 7 new stores opening during the holiday season. Sales of Lidl's premium range benefited from product innovation and publicity of its quality credentials, and these helped to attract shoppers away from the multiples. Indeed, customers switched over £58 million of spend from Waitrose, M&S and the Big Four over the festive period. The standout product was Lidl's deluxe free-ranged bronze turkey, which more than doubled sales and contributed to an 18% increase in overall turkey sales. Other strong performers included hand-cooked crisps, luxury mince pies and brioche burger buns. BWS sales were another highlight. Lidl says its range was the fastest growing in the market and was helped by the launch of new flavours for its artisanal gin range. To promote its new House of Hortus artisan gin, Lidl took a pop-up gin bar on a nationwide tour. The free-ticketed event sold out within 24 hours. Festive vegetable packs were again an important part of many retailers' proposition, and this year Lidl supplemented its 19p packs with a premium vegetable range that achieved 100% sales uplift. Lines include Sprouts trees, Cavolo Nero and specialty broccoli, providing new options for quality-seeking customers. At the Big Four, performance varied. As a group, Kantar surveys found that sales declined by 0.9%, a slightly bigger fall in sales than a year ago. The best performer was Tesco. After a slow Q3, when like-for-likes rose only 0.7% because of disruption caused by its own brand relaunch, Tesco delivered 2.2% like-for-like growth, its fourth consecutive Christmas of growth, outperforming the market in both value and volume terms. Good growth from the UK business was complemented by an encouraging result from Booker, achieved despite the annualisation of contract wins post P&H's collapse early in the period. Morrisons also reported a fourth consecutive quarter of Christmas growth. Though with a more demanding comparative, like-for-likes to its own stores were weak at 0.6%. This meant that it was wholesale operations, particularly its supply deal to convenience retailer McColl's, that were responsible for driving most of its growth. At Sainsbury's, however, the result was disappointing, with declines in both total and like-for-like sales impacted by lower general merchandise sales. So Tesco reported its highest growth since 2009 and also delivered significant gains in its customer satisfaction metrics for both quality and value. Tesco's own brand relaunch certainly helped. It entered the Christmas period with 3/4 of its 10,000 strong private label offer relaunched, including 95% of the exclusively at Tesco value range. New marketing for this range played an important role in boosting the retailer's appeal to price-sensitive customers. Tesco reached out further to price-sensitive customers with a highly competitive Festive 5 offer, which sold 20 million units over the 3 weeks to Christmas. This was complemented for the first time by a Finest Festive 5 promotion. Overall promotional participation was in line with last year at 37%, but targeted on lines for maximum impact. For instance, half-price products helped lift meat sales by around 12%, and Tesco also repeated its 25% off cases of wine for offer. You'll notice that total sales at Tesco at 0.6% were only marginal. This is the result largely of the closure of the Tesco Direct online non-food business last summer. Despite this, Tesco achieved good growth in its prioritised non-food categories. Its Fox and Ivy homeware and Go Cook lines grew by nearly 8%, and clothing sales were up by almost 4%, boosted by a strong performance in women's wear. Morrisons' group like-for-like of 3.6% was materially ahead of last year's 2.8%, as I've said, boosted by a significant contribution from wholesale. Its retail like-for-like, however, was a step down on Q3's 1.3% result, and weaker than any quarter for 3 years. Morrisons noted a change in shopper behaviour. Like-for-like transactions declined, but basket size increased, reversing previous trends. Customer satisfaction also improved, particularly in terms of colleague friendliness and the checkout experience. Basket sizes were boosted by targeted price reductions. Morrisons reduced prices across a basket of 100 popular festive items for the second year running. The total cost fell by 23p, with 3 for £1 pricing on veg packs driving volumes. Morrisons also reported strong sales of its new Naturally Wonky range of seasonal fruit and vegetable items. Besides appealing to price-conscious customers, Morrisons provided more choice for quality seekers and expanded the best range now includes almost 1,000 year-round products and over 250 exclusive lines for Christmas. Morrisons also stepped up product innovation with imaginative seasonal products including a three-course Cornish pasty and vegan pigs in blankets. At Sainsbury's, sales growth turned negative due mainly to weakness in demand for some non-food categories. Grocery sales were up by only 0.4%, pulled down by inflation being at its lowest rate for 2 years. Contributing to this were tactically deployed price cuts to boost its appeal to value-sensitive customers, with products such as £9 turkey crowns and 30p festive vegetable packs. Volume growth was in fact similar to H1, despite fewer promotions than a year ago. And operational performance was good. The availability issues of the summer did not recur, waste levels were at their lowest level, and customer service was strong. In non-food, sales fell by 2.3%, pulled down by Argos's decision not to run unprofitable promotions for Black Friday and weak underlying demand for discretionary products. But sales recovered closer to Christmas. Toy sales were poor, however, with the market down by 10%. That said, Argos stores in Sainsbury's traded well. Sales of 138 units open for more than a year grew by over 10%. Sainsbury's launched 185 new food lines for Christmas, half of which were Taste the Difference. However, encouraging customers to trade up proved challenging as sales growth of the premium ranges slowed versus H1. New vegan lines did prove popular and free-from ranges grew by 14%. Food to order is another area to call out. An expanded range, improved marketing, in-store and online, meant that more customers used Sainsbury's Christmas food to ordering service. Before I move on, I'd like to mention some of the highlights from our events programme this year. First up is the Tesco Business Update, when Dave Lewis and the leadership team will update on Tesco's strategic vision in its centenary year. Then in June, we have the Sainsbury's trade briefing, when Mike Coop and the Sainsbury's and Sainsbury's Argos teams will provide a business and commercial update on Destination Sainsbury's. And lastly in September, we have the Co-op trade briefing, when the theme will be Succeeding Together. You can learn practical ways to action Co-op's retail and wholesale strategy. Booking for all three events is now open. To book your early bird tickets, go to igd.com/events. So now let's take a look at the premium players. In general, growth was weaker than in 2017, reflecting increased competition from the discount sector as well as from the Big Four. At Waitrose, growth was much slower than last year's 1.5% growth, due mainly to reduced promotional activity, as Waitrose focused more on delivering profit growth for the full year. For M&S, Christmas was disappointing. Its like-for-like sales fell by more than a year ago, following actions to lower prices and reduce complex and confusing multi-buys. An undertrade in the wider M&S business also won't have helped. There was better news from Booths, the quality-focused northern supermarket often known as the Waitrose of the North. An overhaul of its own brand range, strong BWS sales, and Click and Collect contributed to a 3.5% boost to its sales and a 4.5% increase in profits for the Christmas period. Worth a mention too at this point is Majestic Wine. Its 1.5% sales growth was constrained by strong competition from the multiples, Aldi and Lidl, in a challenging retail environment. However, growth online and through Majestic's concierge quarterly wine subscription service helped to offset weak trading in the stores. Waitrose's sales may have been flat, but the retailer achieved significant improvements in customer satisfaction measures. Improvements to availability, service, quality, and ease and speed of the checkout process were recognized by customers. Waitrose entered Christmas with 500 new or improved lines that helped to differentiate it from competitors. Eye-catching products included its Heston Blumenthal profiteroles and an edible rosemary Christmas tree. 25 vegan and vegetarian lines were added, including jackfruit tacos, that drove a 94% increase in vegetarian meal sales. Free-from and dairy alternatives also grew strongly. Another area of focus was homegrown wines, with English and Welsh wines seeing growth of 21%. M&S is very much a business in transition as it closes loss-making stores and refocuses its food business. After a slow start to the quarter, volumes grew solidly over the Christmas weeks, though by value, food like-for-likes fell by 2%. M&S is, however, confident its transformation program, started 6 months ago to re-engineer the range and value proposition, is on track. Food hall footfall, however, is likely to be pulled down by a weak performance from clothing and home. Like-for-like sales from this part of M&S's business were down by nearly 5%. In terms of marketing, M&S delivered a strong omni-channel campaign through its Discover Your M&S Favourite campaign. This was well executed and consistent across different channels, encouraging shoppers to join the conversation on social media by sharing their Christmas food favourites. M&S also launched a number of innovative products for Christmas. It took advantage of its exposure to the convenience sector to develop a number of relevant and distinctive products. These included an on-trend vegan alternative to its popular festive sandwich, the No Turkey Feast. And of course, quality is key to M&S's appeal. This year, its festive range received 34 awards in taste tests and food panels. However, this is a field where M&S is having to work harder to justify its premium prices as it faces stronger competition from mid-market retailers and the discounters. Let's now look at online. Data for the channel is incomplete, but at the retailers that have provided figures, growth rates are generally down on last year, so they've become harder to sustain for more mature businesses. Sainsbury's achieved good growth of 6%, having introduced a new picking system to improve efficiency and drive profits. It is also focusing on personalisation and with better product suggestions based on shoppers' previous buying behaviour. At Tesco, online growth slowed to 2.6%, barely half the pace of last year. Rather than drive sales with coupons, Tesco focused on improving the quality of its online business and grew its number of regular Delivery Saver customers. Waitrose achieved double-digit growth. That's on top of 23% growth in H1, as it focused on growing basket size and offering more engaging content to differentiate from competitors. Elsewhere in the online channel, Kantar recorded 12% growth for Asda, a figure that will be in line with previous quarters of 2018. Asda's online sales are benefiting from easier ordering and a simplified checkout and more personal and relevant product recommendations, sometimes reflecting collaboration with suppliers. Morrisons is also likely to achieve strong Christmas growth. It now dispatches orders from Ocado's Erith depot, and a store pick service has expanded its reach in the north of England and Scotland. Improvements to its app and the launch of Eat Fresh meal boxes will also have helped. So to wrap up, 5 themes from Christmas 2018. Firstly, weaker inflation limited growth. With sterling's devaluation no longer feeding higher prices, food price inflation was much weaker than a year ago. However, with shoppers keen to contain their festive spending, volume growth was restrained. Secondly, we saw increased investment in seasonal innovation. Encouraged by the success last year, discounters strengthened their seasonal ranges to engage shoppers. Multiples also invested in premium ranges, but tougher competition tempered their sales uplifts. Thirdly, retailers focused more on emphasizing low prices, and promotional levels were similar to a year ago. That said, festive vegetable packs and reductions in main meal prices were once again key to securing festive main meal shoppers. We saw a lot of success stories with non-traditional products. Vegetarian, vegan and free-from ranges all achieved strong sales growth as shoppers responded to investments in these ranges. Lastly, we saw challenges in non-food. Demand for many non-food categories and for clothing was weak, impacting the performance of retailers with exposure to these ranges. And so to wrap up, a quick look at the strategic challenges that face our industry in 2019. Brexit, of course, is top of the agenda. It introduces many uncertainties for food businesses, and maintaining continuity of supply to shoppers will be crucial. Retailers and suppliers will need to work together to ensure a continuation of normal service. Possible areas of focus include changing product specifications, local stock building, sourcing more stock from within the UK, and developing expertise in import and export administration. The creation of more space by discounters and the shift to shopping online will create pressure on many retailers. We've seen a lot of activity already around store reinvention. Sainsbury's new Selliec store shows what can be done with bigger stores, while Tesco's Well and Express store shows how new thinking and new technology can raise performance of convenience stores. But expect this to be a continuing priority for 2019. Meeting shoppers' rising expectations will be another theme for the year. The topics of health and environmental impact are here to stay. However, there are big leaps ahead to move from aspiration to action and from action to impact. Hurdles to overcome include the complexity of defining, measuring and finding solutions, the cost to implement changes, and achieving collaboration across the supply chain. Competition is intense in this period of weak market growth, fueling industry-changing M&A activity and business developments among suppliers and retailers. The CMA will rule shortly on whether the Sainsbury's Asda deal can go ahead, and if it does, it will profoundly affect the shape of our industry and could well trigger further corporate activity. And lastly, in uncertain times, delivering value to shoppers will remain a key means to drive volume growth. With less use of promotional tactics, retailers will need to invest more in creating a differentiated proposition that engages with diverse shopper missions. So that's about it from me, but before I sign off, a quick mention for our Brexit webinar. Our chief economist, James Walton, has been discussing how the industry should prepare for a variety of Brexit scenarios with government departments and through our own industry expert groups. On January the 29th, he'll present our view of what could happen next, how the prospect of a no-deal Brexit may affect shopper behaviour, and the most important practical actions you should take now to limit business disruption. You can register now for this webinar at igd.com/Brexit. Okay, so that brings us to the end of the presentation. If you do have any follow-up questions or would like to know any more about how IGD can help your business, do feel free to contact me. I look forward to hearing from you. Thank you very much for listening.